Good morning. My name is Dr. Arun Upneja, Dean of the School of Hospitality Administration, or SHAW, at Boston University. On behalf of the faculty, staff, and students of SHAW, a warm welcome to everyone attending today, the finale of our distinguished speaker series of Spring 21. Before I introduce our guest, please know that we welcome your questions during today's session. Please type them in the chat box addressed to Professor Leora Lance, and time permitting, we'll be happy to ask them to our guest on your behalf. Today's topic is navigating hospitality finance in a rapidly changing market. Now that vaccinations are increasing and spring is here, maybe not today in New England, but we're all starting to feel ready to get back out there for road trips, restaurants, movies, bowling, and whatever else that our heart desires. We need R&R. To prepare for this pent-up demand and heightened expectations, hotels and other hospitality outlets will require an influx of capital investments to make the necessary upgrades. Dilip Petigara, the former CEO of Access Point Financial, a leading direct hotel lender to the hospitality industry, has successfully managed the roller coaster ride of market ups and downs over his 20 plus years in hospitality and finance. Today, we are fortunate to get his perspective on the short and long-term opportunities that lie ahead and what it will take to get back to business, even if it is not as usual. Please note that Shaw has a concentration in real estate at the undergrad level and at real estate and development at the graduate level, with courses like hotel development and deal making, real estate financing and feasibility, financial reporting and analysis. And I'm also happy to announce that we have a new faculty member specializing in real estate, Mr. Kaushik Vardarajan. So please check out our program. And here is another plug for Boston Hospitality Review, BU Shah's very own journal covering topics and trends by leading experts in our industry. The current issue happens to have been on real estate, which is the topic of discussion today with our guest. We'll put the link to BHR in the chat so that you can subscribe today. The May issue on leadership is coming out very soon, so you don't want to miss it. Our guest of honor is Mr. Dilip Petigara, former CEO of Access Point Financial. It's okay if you've never heard his name. You will come across his name only if you want to be an entrepreneur and open your hotel, in which case you'll find yourself making a trek to his office to get financing. Now that I have your attention, Mr. Petigara has a master's degree in tax law and an MBA. He started his career with Deloitte & Touche, moved to GMAC Commercial Mortgage as Assistant Vice President, Senior VP with Specialty Finance Group, and then MD with Latitude Capital Advisors. Finally, at Access Point, where he rose through the rank to become Chief Executive Officer. Please welcome Mr. Dilip Petigara.
Good morning, thank you.
Welcome to the Dean's Distinguished, and we are very happy that you are here. We want to start off with your rise, your meteoric rise to the C-suite. Congratulations, but we are all curious to know, how did you get into the hospitality finance business to begin with?
Well, my family's in the business and has been in the business for a long time. And my interest has always been on the financial end of it, the numbers end. You mentioned that I had a master's in tax law. I got my law degree as well, but never wanted to practice law. I always wanted to be on the business side of it. So really the focus in my MBA was finance. So that's where I got the interest in the numbers and the finance end of it. And that was really the contribution, my contribution to the family business as they were, building and developing hotels 20 plus years ago. Through that is how I got my involvement in that. And it was really after I'd moved on from Arthur Andersen to Deloitte & Touche that, there was an opportunity to go join GMAC Commercial Mortgage in their asset-based lending group. So I did that about 20 years ago, and started off as an underwriter, so evaluating hotels, slightly different from, it's really the feasibility, but a feasibility from a lender's perspective, as opposed to developer, owner, operator's perspective. So once I started that, and that was really what my foray into hospitality finance was, and it was just kind of the natural progression and growth from there.
So you talked about all this quantitative side with Arthur Andersen and other companies, but I want to ask you about, so that's a lot of quantitative, but what are the qualitative aspects of being a CEO, being a leader of any company?
Well, certainly, I think it's challenging, and I think that the qualitative aspects of it really have to do with. I think you have to. There's a significant portion of it that's got to be, being able to evaluate the big picture, seeing where it is, what the goals are, and trying to manage the various stakeholders. Those stakeholders are your employees, the associates that you work with. Those stakeholders are your investors. Those stakeholders are, depending on how you finance your business, they could be your lenders. And then, the various other constituents that you have in hospitality, right? Whether it's the borrowers, the owner operators as a lender, even the brands, the franchise companies, they are stakeholders as well. And then your third party management companies, and it's really kind of trying to manage all that and balance in terms of what those competitive needs are, and really trying to thread the needle in terms of what your needs are as a platform. I think a significant portion of that is communication, just like in any relationship. That is important, and trying to set out goals for the organization that everyone is signed off on from a leadership perspective. The various department heads, and trying to getting their sign off on those goals as well. It's not the easiest thing to do. You have different personalities, as you know, and different mindsets, but that is what I think is some of the key issues and key challenges, and particularly during a crisis situation. Certainly, even I could have, reflecting back, communicated more, and maybe over communicating would be important, in order, and particularly in this environment, now that we've all gone to to Zoom. Even this lecture series has been on Zoom. So I think communication is significantly important, and I think that is the case in any relationship.
So Dilip, as you were describing the complexity of the task that a CEO faces, you were moving into areas that sort of reflect your personal leadership style. So you've been in these C-suite roles for many years now. So what is your leadership style? So what do you think of when you move into a new role, a new company? How have you evolved your style over these years?
That evolution's a daily basis, and it certainly takes some reflection, and it takes, I think, an understanding of yourself, right? So empathy plays a big role in leading people. There's got to be measure of empathy in the way you communicate with them, and the way you correspond with those individuals that are in your reporting, if you will, or in your team. It's important because everyone is motivated differently. There's some different intrinsic motivations that we all have, and I think that it's important to understand that everyone comes from a different place, and it's not the same method won't work on everybody. And again, part of that is not just this my way or the highway. There's a reflection back. right? So it's that mirror where you're looking at and saying, okay, now reflecting back, how am I coming across? What can I do differently? And what's the evolution that I need to take as an individual in order to continue to grow in my role and my effectiveness as a leader? Generally speaking, I'm very detail oriented, but I am not a micromanager. But and that I can understand how that sounds conflicting, right? I mean, it's kind of, here's the task, and now I'm not going to tell you exactly how to do it, but I will understand the detail of it. And I think that's probably the difference. At least that's how I reconcile. So I think that's probably my style. And like I said, if there was something that I've learned and continue to learn, is that communication is key, and again, probably over communicating in times like this, where it may be required, in terms of, this is what we're doing, this is what we're seeing, these are the challenges, what are you seeing? And I think that that is something that's important. So a lesson that we will all grow from. This is not something that any of us have experienced, but certainly a lesson that we will all grow from.
Thank you. That was very interesting. And I really like, you are in a very quantitative business. I mean, the underwriting and the financing. So I really like the phrase you said, that you are very detail oriented, but you're not a micromanager. And I think that is a sort of a needle that has to be threaded very carefully. So thank you for that. Another thing you also said, which I hope everyone took note, that it is an evolutionary process. So you learn every day. So I wondered now, one of the things I mentioned, that you've been this, and you said from the early 2000s. So this is our third big crisis that we are facing. So how do you deal with these crises? Do you have sleepless nights, or have you come up with some ways in which you deal that you are able to handle this and move your company forward without losing any sleep?
Well, you that goes back, a little bit goes back to that empathy, right? Because that empathy is not only for your employees, but that empathy is for our borrowers. That they are a stakeholder as well, right? I mean, the owners, I think, are the ones that were the most deeply impacted by the pandemic, because ultimately the buck stops there. They're the ones that have to make those debt service payments. They have to make the real estate taxes. They have to make payroll. And they're the ones that really had significant sleepless nights, right? As a lender, we're collateralized, meaning that we're making a loan against a physical building, an asset. And ultimately, in a meltdown situation, the lender's collateralized by that, right? They can go and foreclose on it. They can, sue on a personal guarantee, and maybe ultimately recover, their money. Listen, it's pressure, right? It's pressure for everybody involved. And even then, what I tell my people is that during times like this is when you really want to have your eyes wide open, and really this is when you learn the most. During these crisis times, and again, this is the third cycle through. During these crisis times is when you learn the most. You learn about the character of the people that you're doing business with. You learn about how people react in certain situations. And it really helps you understand the business, significantly more. This time it was a health crisis, right? That impacted hospitality, hotels, travel industry, et cetera, deeply, deeply. Last time it was a financial crisis where the credit markets just seized up. There was no money available. And then, 9/11 obviously was a terrorist incident. So, there are different things that happen. I don't think anyone really expected that this one would be as long as it has. And you mentioned early on that there's some positive feeling coming out of this now with the vaccinations and the numbers of vaccinations increasing. It is getting warmer. and people are anxious to get out there. And again, I wish I wish I'd seen where I read this, because I would give it the proper attribution. But it's what it's what I read, and that someone called revenge travel, and I loved it because it's exactly what's going to happen the balance of this year. The second half of this year, people are just going to go out there and go because they just haven't been for a year and a half, 15 months, and they want to get out there. So I think that's going to be important, and it'll be interesting to see. But it's also understanding the recovery, right? So it's these are the times that you really want to pay the most attention. It is challenging. There's a lot of pressure. As a non-bank lender, we're owned by private equity, and there's pressure there because they're ultimately looking for a return on their capital and to maximize that return on their capital. And why not, right? That's their prerogative, and that's why they made the investment to begin with. So in those instances, it's really important to really try and understand again, how you can maximize that. And the benefit of being a non-bank lender is you have a little bit more flexibility in terms of how you can deal with it versus a traditional bank lender that has regulators, that whether it's a state regulator or a federal regulator, those regulators and the laws dictate how they can deal with these things and what impact that has on their own balance sheets and the performance of the bank. So there is a difference there as well in understanding, what you can do. A non-bank lender has more flexibility, but that also means that maybe they can structure something that says, okay, if I will give you a forbearance today, meaning I'm not going to exercise my rights that I'm allowed to exercise, because of my loan documents, but we'll structure something where I'll give you some benefit today. You can pay me a lower amount, but on the back end, you're going to pay me a higher amount. So I'm going to make up the difference, right? Traditional banks don't necessarily have those types of, that type of latitude, but non-banks do.
So what I want to ask you about these, the three crises that you talked about and how each one is different. What is your sense right now? Are we getting towards the tail end of this? What is your sense of optimism for the rest of the year and this coming year?
I think the reality is we are in the beginning of what will be a new paradigm. Life has changed for all of us. And we will see that in hospitality, and also in how we do business. I think you will see a little bit more increase in technology from a business perspective, like Zoom, Microsoft Teams, right? There'll be more of that employed and less of the physical, travel and the face-to-face. In the hotel world, I think we'll see an increase in technology utilization, and I think that this crisis has accelerated the deployment of technology to improve the efficiency of the hotel operation. And there are plenty of articles out there about whether it's robots that deliver food and beverage, talking to other owners, whether it's Roombas that end up in every room to vacuum. So it's a little bit less, manpower in terms of housekeeping and less time in terms of keeping the room clean. And even the technology in the room itself, right? The television technology and especially with the television or computer technology, as that proliferates, what you'll see is probably QR codes, like even now when we go to restaurants, they don't give you paper menus anymore. Typically it's a QR code that you use your phone camera and you pulls up on your phone. Well, the QR code in the room will instruct the guest how to connect their computer to Wi-Fi, or how to access Netflix on a personal account so they can watch TV on the computer, right? So there's efficiency there that's that's gonna come out, and I think that this pandemic has really accelerated that. And that has been, you know, a shift that we will see. So the new, what are things going to look like? I think the second half of this year, it's going to be a rubber band effect, right? So people, you know, people are going to want to get out there, and there will be a significant amount of, you know, leisure, pent up demand, leisure travel, whether it's drive to or even kind of transcontinental flights, right? So you're going to see that. And even traveling recently, the airports are busier than they were 3 months ago. But what we then see is that rubber band will snap back at some point in time. So it's going to reach the new equilibrium. It's going to come back to a steady state, and it may not be as robust as it is the second half of this year. And that's why I think it's going to be a 3-year cycle or horizon for recovery of the industry back to 2019 levels. But there will be a new a new line that's created, right? What is that new standard going to be going forward? And we will develop that. But the, you know, the beauty of it is that we as humans are, you know, creative or adaptive, and that's something that we will certainly see. And then we've always kind of pulled through these challenges and these crises. So I you know, I'm hopeful from that perspective.
On that hopeful note, Dilip, I'm going to pivot a little bit. We have a lot of students and young alumni and young professionals who are watching this, and some of them are actually experts. They are already underwriting hotels and doing other kinds of real estate activity. But we also have students who are very new to this. So let's just start with the basic. An entrepreneur wants to start a hotel, wants to build a new hotel, $10 million. How does that money get financed?
The typical way is that if it's a $10 million project, they're going to have to put up probably 3 to 3.5, 4 million of their own money, and then go out and try to borrow the balance of it, 6.5, 7 million. What they will go and try to borrow will be from debt sources, whether it's a traditional bank, whether it's, you know, the local bank, you know, at the corner, or whether it's one of the more regional or super regional banks, you know, national banks like Wells Fargo, Bank of America, or it could be a non-bank lender, you know, like you know, the firm I just left. And so depending on what their source of financing is, will determine the cost of that financing for them. And then it's just a matter of, okay, well, here's my cost, here are my terms, this is my interest rate, this is my term. And, you know, it's modeling into your projections the cost of repayment of that debt, and then coming up with your, you know, IRR analysis. That's the traditional way to do it. You know, there are alternative methods that we see today. Some of that is what we call, you know, well, tax credits, you know, depending on where you're doing a project, whether it's acquiring an old building and doing a significant renovation to it, adaptive reuse. There could be some historic tax credits that are available. Depending on the jurisdiction where you are, there's what they call property assessed clean energy financing, CPACE, commercial. And, you know, so those are alternative sources of financing that help you fill that capital stack. You know, with the capital stack being the 10 million that you talked about, the total project. And then what will the various buckets be that total the 10 million, and what will the sources for that financing be?
So roughly speaking, let's divide this into banks, whether they're local, regional, or national banks. And then you have these non-bank lenders. So what is the difference between why should I go to one versus the other? Or is it simply a interest rate game that wherever I can find the lowest rate? Are there any advantage to going with non-bank lenders?
I, so it's a relationship. I mean, this business, this industry, in my perspective, is significantly a relationship business. And particularly on the financing side of it as well. So the answer to your question specifically is, I think that non-bank lenders, and particularly ones that have a specific focus on hospitality, are probably the best source for this asset class for financing long term. Non-bank lenders are ones that are in the space exclusively, and that's all they do. Traditional bank lenders do have, because of regulations, have concentration limits, meaning that they have to diversify the asset classes that they lend against. It could be, a gas station. It could be the retail store. It could be a shopping center. It could be self-storage, hotels, office building, but they can only lend a certain amount against each of those asset classes. And what you will find with traditional bank lenders, depending on the size of the bank, that they may fill up over time. And once they fill up, then they can't do anything until loans get paid off or the bank grows more, right? So they have more capacity to lend against that. So when that happens, it's difficult to predict, whereas a non-bank lender doesn't have the concentration issues. They are more expensive typically. So it is a trade-off of rate. But I think in the long run, specifically for the hospitality asset class, because it is the most challenging to underwrite from a lender perspective. And why is that? Because the inventory, meaning the rooms that you're selling on a nightly basis, are perishable, meaning that they're here today and gone tomorrow and never to return. So it's very difficult for lenders to understand that if they don't have the expertise in the background. What's great about the industry is that it has the data available to it. As you know, Smith Travel Research reports, or Hotel Horizons reports, or forecasts that are look back historically. So they look at specific empirical data and then make predictions. You can make projections based on that. So it's a fine balance between qualitative analysis and quantitative analysis in terms of underwriting the feasibility of a hotel.
That's very interesting. So if any entrepreneur is looking for finance, then you can get stuck in banks because they don't understand the business, or they might have reached capacity controls, whereas a non-bank lender that specializes in hotel financing, that's all what they're doing and they're experts in it. So your loan gets approved faster and there is no opportunity cost. And it was very interesting that you mentioned it's a relationship business. So all the more reason to get to know people in the non-bank sector. One example is Mr. Petigara here. So for everyone watching, get to know Mr. Dilip Petigara. So now what I want to do is just sort of step back a little bit, and where are these non-bank financial companies getting their money from? Who is investing in those companies?
It's typically private equity. So it's a variety of sources, but some may be sovereign wealth funds, that are investing. Others may be private equity groups that they get their financing from, whether it's life companies or other pension funds. So it varies, but specifically it's going to be private money that's lending money to non-bank lenders, and the non-bank lenders also access conventional debt markets from a different perspective, meaning that a non-bank lender may go to a large national bank, and that large national bank makes loans to finance companies. And so it creates a lending relationship with a large bank, national bank, to provide financing for the non-bank lender's ability to go out and make loans. And what the non-bank lender doing is typically just like we talked about that hotel example. A portion of the capital stack is going to be equity, and then the other portion may be debt. And it's the same thing, just in a slightly larger scale, but that's about it.
So now let's pivot to what happened over the last 1 year, and it is on everyone's mind, the pandemic. So it was very traumatic. Travel stopped right away. So hotels and restaurants and airlines, everyone sort of had a steep drop in their revenues. So a hotel which has a mix of equity and debt, a substantial part of debt, as you mentioned earlier, they also have payroll, they have taxes to pay. So how did the owners of these assets manage to survive this past 1 year?
They first and foremost, they made some tough decisions and hard cuts, because they had to, and that that probably meant laying off some people. The industry itself has been significantly impacted by layoffs. I think 4 million or so is the most recent number I saw that are still unemployed. And so really the individual workers are the one that suffered a lot as well. They made cuts in terms of how they operated the property. Now that in and of itself is not necessarily a bad thing, right? I think when we were looking at the 10-year run that the industry had leading up to March of 2020, there was a lot that was forgiven, a lot of expense creep that was forgiven because everyone was doing well. And when that money flow stopped because people stopped traveling, they really had to evaluate spending every dollar, and does it make sense to spend this dollar here, or where else can I deploy the dollar? So it made everyone more efficient. And the owners dug into their pockets and their savings to make up. They ultimately still had to pay people's payroll. They still had to pay taxes, and they still had to pay franchise fees. They still had to pay their lenders. Lenders were able to give what we call forbearance or deferment, meaning that they reached an agreement with the owner to say, okay, you don't have to pay us for the next 90 days or 180 days. And what we'll do is whatever interest that we would have been owed during that time, we'll just put onto the back end of the loan. So when you pay it off at maturity, you'll owe us that money, or we'll give you 6 months. And then when you start resuming payments, you'll start making up the difference of what you would have had to pay. And whether you were a non-bank lender or a traditional bank lender, everyone was doing that last year and giving that relief. And it just depends on each finance company's own internal guidance and their own internal restrictions in terms of what they were able to do and how much forbearance they were able to give. And then significantly, what helped was what we call the PPP loans, if you've heard of those, right? Payroll Protection Act. That has helped. There were 2 rounds of that so far, and that has helped significantly, at least keep people employed, theoretically, right? And then in addition to that, whether it's the economic injury disaster loan, the EIDL, or some other federal programs that have really helped them survive. The March through June shutdown was pretty dramatic. Last year, summertime, we saw things improve, particularly in drive-to destinations. We saw some hotels that, despite the shutdown, we're still operating at 90% because they were a beach, hotel. And then others that, based on where they were located, were barely operating. 10%, 20% occupancy. So there was such a broad difference between, where they were and how they were performing. But summertime came about, everyone started improving a little bit, but then we saw the next wave in the winter, and that hurt it again. And your students know typically these hotels make their money in the summertime. And April through October is the typical season here in the US, in terms of where they make their money, and they were not able to make it for a significant portion of that. And even when they were, it wasn't anywhere near what they historically do. When in the summertime they might operate at 90% occupancy, regardless of where they are, because of travel and other events and reunions and things like that. And they weren't operating at that level. So the next shutdown hurt them again. That's why the next round of PPP helped. But the lenders themselves, I think at this point, may have exhausted what relief they're able to give. And with that, will come more of the challenging conversations. But the good news is for the industry anyway, that I think that kind of converges with the fact that vaccinations are out, and a significant, what is it, 25% of the population so far have been fully vaccinated. And travel's coming back. Summertime is, the warm weather helps. And I think that will all maybe help bridge, that divide and get people back to something that's a little bit more normal, like we talked about earlier.
Dilip, I want to go back. You mentioned the last March when everything just shut down, and April to October is the biggest. And even before that, there is another narrative, another story that has been circulating, which is that this was a 10-year-long boom time for our industry. And there was a story that there is going to be some sort of a recession, some drop-off in the economy. And then there was this lot of talk about a lot of capital sitting on the sidelines, waiting to swoop in on assets whenever there's a recession. So we didn't have the typical recession we were thinking, but the pandemic sort of acted like that. And a lot of asset owners had to bear this pain. You described that in detail. But have you seen a lot of assets come into the market at this point? There doesn't seem to be a deluge of hotels coming into the market. So what is the perspective of that, those companies that were waiting to come in, and do you see these assets, distressed assets coming into the market?
Certainly there was not the deluge of the assets coming online last year that anyone thought. A significant reason for that is, the fact that the lenders were able to work with their borrowers in giving them the deferments that they needed or the forbearance that they needed in their loans. The biggest reason for that is, the regulators for finance companies, or traditional bank lenders specifically, say that when you go and modify a loan, especially payment terms and things like that, then it's considered a troubled debt. And when it's considered a troubled debt, the regulators require that bank to reserve more capital against that asset. And so because of the fact that the regulators made it, a conscious decision not to enforce troubled debt relief requirements, it gave the banks more flexibility in terms of dealing with their borrowers. And I think that was a significant reason for not seeing as many assets hit the market. Certainly we've seen some lenders, look to explore loan sales in the market. And then we've seen some assets that may have moved to foreclosure or bankruptcy. But I think that particularly the ones that moved to foreclosure or bankruptcy so quickly, I think that they were headed that way, and in my opinion, that goes back to the character of the sponsor, right? I think there was already an issue there, and this just accelerated that issue. That it required the individuals to confront it a lot sooner. It'll be interesting to see what happens now, because now that banks have, it's been a year or more, and now the banks have exhausted their ability to continue to make those deferments. If the borrower is not able to start picking up the payments and resume making payments per their contract, then there will be more of these approaching. You will see bank sales maybe increasing. Exploring the sale of the loans themselves, and then you will also see perhaps an increase in foreclosure activity or bankruptcy activity. But that again is coupled with the fact that things are improving. I think it was 59% occupancy last week for the industry as an average, 57 the week before, and then 50 the week before that. So the industry is moving up. We're coming into the summertime. It's April. It's the natural time for the hotel performance to improve. And so ideally, we will see that continue, and may not have a lot of assets hit the market. But again, some of them will be challenged, and the ones that are challenged are because the operators aren't taking advantage of operating more efficiently, or they are taking advantage of trying to game the system. And lenders will see through that, and they'll go enforce their remedies if they need to.
So you mentioned that banks have reached the limit of the forbearance. So I just want to sort of get a little bit more detail on it. Is that because the earlier one you mentioned that regulators said, okay, you don't have to adhere to the normal capital requirements whenever you have a debt restructuring. Now, has that patience of the regulators expired? Is that why the banks are reaching the limit, or is there some other reason behind it?
That will be the reason behind it. And specifically to answer your question, I don't know. There was discussion about the fact that they would start requiring additional reserves to be put up against that troubled debt. I just don't recall when that date was specifically, but it is coming. The other thing is, depending on how you finance your business, and particularly the non-bank lenders, when they finance their business with other national banks that give them warehouse lines or other finance, we may have exhausted, those non-bank lenders may have exhausted their flexibility and the forbearance that they were given from their lenders. So it's just a trickle down from that perspective, right? I can only do so much, and then when I can't do any more, then we can't, and then that's when you start having to have the more difficult conversations with the ownership. But even that goes back to what we started talking about, where communication is key. Even if you don't have anything good to say, pick up the phone and say it. Right? I mean, you have to communicate, and if you're not communicating, when you just can't leave the other side to guess, because left to your own devices, your mind can go different places. It's not going to be pretty. So communication is a key. You really have to kind of let your lender know exactly where you're feeling the pressure, the pain that you're feeling, experiencing, how you're dealing with it, what you're doing to do the best you can under the circumstances, and demonstrate to them that you're doing everything you can. And then that improves your chances the most in terms of being able to continue that dialogue with your lenders.
So I have a comment here in the chat from Mr. Ashok Patel that regulators have given until December 2022 to hotels to catch up to their normal DCR. So my question is, with this extra time given by the regulators, plus the efficiencies that you talked about, plus the fact that travel is picking up and the pace of vaccinations is increasing, so what about all the capital that is lying on the sidelines, waiting for distressed assets? That huge deluge is not likely to happen. Is that a fair assessment?
Yeah, I think so. I mean, based on all that, I think that the huge wave is not likely to happen, but there will be opportunities. That capital will have an opportunity to go somewhere. And that capital could have an opportunity to become rescue capital, if you will, right? Where they're making strategic investments in assets that, in 2019, for example, maybe they were doing a $3 million NOI, and in 2020 that dropped to 1.2 million because of significant reduction in travel, and it will take time to get back to the 2019 level. And in order for them to get back to that, they may need some operating capital to do so. So certainly valuations have been impacted significantly, and that's going to take a long time. Even though the cash flow may come back, we always measure valuations based on a trailing 12 basis, right? So you look at that NOI over T12, and if it's 1.2 today, and just run a 10 cap on it, it's $12 million versus 2019 it was 30 million. You know that if other things don't change in the market, meaning, and the one good thing that's happened here, and then going back to your earlier comment about the 10-year run and something was coming, no one expected it to be this. But certainly we did expect it probably to be, new supply and demand's reduction based on new supply growth. And that new supply growth has been dramatically curbed through this pandemic. I think that's okay, because then it gives the opportunity for the existing hotels to kind of fill up again. And then what we've also seen as a result of the pandemic is certain hotels have left altogether. Some have closed permanently. Some have shifted their use from hotel space to assisted living or kind of multifamily. And as you see that shift with the supply coming down and the new construction not replacing it at the same clip, as demand comes up, you'll be able to see a more dramatic improvement in that NOI. But going back to the point that the rescue capital that could come in would be for, okay, I know that this hotel, based on the other market forces, is worth $30 million because that's what it was worth in 2019. I can make an investment here, and this is how I can make my money back in the next 2 to 3 years, for example. And we may see that. I mean, capital's creative. Regardless of the source of the capital, it's very creative. So it may not be exactly what they had, thought it was going to be for, but they will find a way to have it earn, the returns that they need.
On that hopeful note, that a whole lot of distressed assets will not come into the market because the owners have already had a lot of pain over the last 1 year. So I'm going to pivot, Dilip. We have a lot of students watching, young professionals watching, and I want to sort of have just a brief conversation with you about career prospects in the real estate side of the business, and what should students be learning in school or college, and what kind of experiences they should be gaining, and if this is, in your mind, a good career option for hospitality students.
Well, I think it's a great career option. And I think the most important thing is the extent that they can take their time now while they're still learning, to learn all the aspects of the business. And what I mean by that is that, while they're in school, maybe go work the front desk at a hotel, right? Go work part-time at a front desk if you can. You want to learn the operations side, regardless of what you end up doing, because it just gives you a better perspective. I think the more fuller your perspective is, with respect to the hotel operations, and the day-to-day, what challenges hoteliers face, and I think that will help you down the road in terms of being on, whether it's on the real estate development side, the finance side, the management side, whatever the case may be. So I think perspective is important. Other than that, it's finance. I mean, from my perspective, it's really just the numbers. You have an affinity for numbers. You kind of understand them. I think that's a good resource. The other thing that helped me was just my education, having the law school education as well, the legal education, I think was importantly helpful. I think that having that foundation really gives you um, certainly more confidence, but it also gives you the ability to know and access the resources that you may need. And then just understanding things, in terms of contracts. And I mean, finance is a very document-driven business as well, as you know. It's all about the documents. Franchise agreements are hundreds of pages long. So it's really understanding all that in terms of, what it means. And I think it's important, to be able to do that. So, yeah, I mean, I encourage it. I think it's great. And if that's what you want to do.
Thank you, Dilip. I did expect that you will say good things about this career option, and I hope the students listening are, when they next read a management agreement or any other kind of an agreement, that you have that little patience knowing that this is going to pay big dividends in the future. So Dilip, I want to turn it over to Professor Leora Lance. She has a different set of questions for you, as well as some of the questions that have been coming to her in the chat. And I will be back in a few minutes. So thank you very much. Really enjoyed the conversation with you. So on to Professor Lance.
Hi, Dilip.
Hi.
And thank you for inspiring our students who have a passion for finance and development and the lodging industry. So thank you, because a lot of us are here today. A lot of the students, undergrads and grads, are here today. Out of curiosity, have you seen a new generation of hotel owner emerging in the last year or so? Are you seeing new folks who are going into that part of the business?
That's a good question. And I don't know that I have a good answer for that yet.
Fair enough.
I think, a significant portion of the business is, a lot of it's kind of family owned, if you will, right? As you know, I think 60% of the industry is made up of, the Asian American, community. And, so that's a family business. And I think particularly through this cycle, especially in times of trouble, it's when you really kind of retreat to home base and you have to really kind of come together in order to be able to get through it. So, but there will be a new class that emerges, right? So that goes back to my comment earlier about that, that this is something that from an industry perspective, we are, we are creative, we're resilient, and we are going, there will be a new class that emerges, from this.
Fair enough. This I hope doesn't get to be a hot question, but you did mention supply before. Do you think some of the distressed assets that we might have seen, was it because of already oversupplied markets? Or was it more operational issues and they were sort of inevitable?
I think it was a combination. So if the market became oversupplied, you saw the challenges typically speaking, you saw the challenges in the assets that were older within that, right? If new supply comes in,
Fair enough.
the natural reaction or natural tendency is going to go to gravitate to the new supply. But what that requires is the older supply to renovate and reinvigorate themselves, right? And when capital becomes an issue because performance starts dipping and then you don't have the capital, it's that kind of quick, steady stream downhill,
Like
right?
a domino effect.
Yeah, I mean, if you don't have the money to do the renovation, but the renovation is necessary in order to improve the operations. So I think you saw that, but then there is probably a little bit of it that's people trying to take advantage of what's going on, and that's where the character issue comes in.
Yeah.
In terms of, okay, lender A, you made a loan here, and what you may have missed, because you can't always underwrite to the character of the person. You don't know it unless they're challenged. And then when they do become challenged, if character becomes an issue, well then, when you become lender B, you won't ever make a loan to that person. You know,
Right.
so you know, it's some of that as well.
You know, you mentioned and seasonality earlier. Do you think seasonality might change going forward? Do you think seasonality might be more year round just because of the way people have been able to work remotely or take time differently than ever before? Or is this sort of a short term thing? Not that we can prognosticate, but just curious as to your thoughts, seeing this from your perspective.
Good question. If I were to say that there would be an impact, I think climate change may have an impact on seasonality.
That's good. That's interesting.
That may be a little bit. You could probably point your finger to that more than you know, change in work patterns. You know, you're right. I mean, with technology, you can work from anywhere, but at
Yeah.
some point in time, people are going to require people to go back to the office, right? I mean, you know, you know, what will happen is office space will still be there. You may not have all the space that you had before.
Right.
Reduce your footprint and give a little bit more flexibility in terms of people's ability to work from home. But you know, one of the biggest things that was missed over the last year and a half is the collaboration. You can't, I mean, you know, I don't, Teams and Zoom, this collaboration is just not the same.
That's right.
You know, when you can be in the same office, and you know, we are a social being as well, right?
Mhm.
Social is an important part of the workspace as well as it is, you know, just like when you're in grade school growing up, right? They talk about social and emotional as part of the
Mhm.
education process, right? I mean, that doesn't change. Even college, there's still a social aspect to it. And then even in the workforce, there's a social aspect to it that you miss when you're looking at a screen.
You mentioned climate change, and actually, one of our students, one of our undergraduate students, Bailey, had submitted a question having to do with sustainability, actually, not necessarily environmental, but sustainability. And again, this is pulling you back, Dilip, sort of from a higher level to look at the industry, since you really do have that great perspective to see what's going on. What do you think the role of sustainability will play in hotel development going forward? And does that impact lending from
It
what you've seen?
it does,
Okay.
because it impacts the cost,
Oh,
right? So until something's adopted, you typically have a higher cost associated with it, which is what there's probably you know, resistance against doing that, right? What's the benefit of me going solar if solar panels cost X and it's going to cost me a lot more money to put on the property, and my return on that's going to be X amount of time. But as a cost, as more people adopt it, and cost of that comes down over time, then what it does is it helps you on the operating expense side, right? I mean, it helps the climate, obviously from a sustainability perspective, but it helps you on the operating side. And on the operating side, then you know, it's the NOI, the ability to, you know, meet debt service coverage, and your ability for and your valuation. So you know, it will, depending on what it is, it'll take some time, but you will see that. And we've already seen some sustainability measures, you know, be taken up. I mean, the brands are trying to enforce it as well, right, in terms of their initiatives.
right.
But you will see more of that. That's also a big portion of what the property assessed clean energy that I talked about, you know, the PACE financing earlier, that is really intended for renovations or new construction for, you know, the energy efficiency when you're replacing windows or replacing old air conditioning units with new air conditioning units that are more efficient in an old building with conversion. You can you know, access PACE financing as part of that,
Okay.
and or even in a new build. So we'll see that, and I think you know, the industries have to kind of work together in order to make that happen.
Definitely. I know we're at that hour. I did want to ask one more question of you, even though there's lots here from the students. But before I turn it back to Dean Upneja, thinking maybe back just prior to the emergence of the pandemic, were there any interesting projects, just out of curiosity, any interesting hotel projects that you were involved with that were memorable or different in some way, that sort of stand out as as an accomplishment or something that you were proud to partake in?
You know, the most interesting to me, just from a lender perspective, that were always fun to deal with were probably the adaptive reuse. It's someone acquiring an office building in a central business district and converting that office building into a autograph collection hotel, for example.
Okay.
And the capital stack is made up of tax credits. It's made up of, you know, traditional debt, equity. It's complicated, right? I mean, there's a lot of moving parts and moving pieces, but those are always the most fun to kind of wrap your arms around
I
and work
can
on.
I can imagine. Was there a particular location, or can you think of one particular asset in particular that?
Yeah, I mean, we done, you know, downtown Birmingham, we did one. It was an office building that was converted to an autograph collection. It was called the Elyton Hotel, Elyton. I think he ended up getting a write-up in Architectural Digest on it, which was kind of cool as well. So,
Yeah.
you know, but what's really unique about particularly the soft brands is that, you know, it allows the property to have its own unique flavor, if you will, but still benefit and access the, you know, in this case, the Marriott reservation system.
Right.
But, you know, it's really, you know, combining the design element with, you know, the construction element and the brand element to kind of, you know, come up with something and see what they create, you know, and you know, that those creative minds are even, you know, I can't even comprehend that, right? I mean, it's
Yeah, those are fun.
having that vision, which is kind of cool. So those are the most fun.
Okay, Elyton in Birmingham. I'll have to definitely look into that. Well, thank you, Dilip, very, very much. And because we are at that time, I do want to bring back Dean Upneja to wrap up and close. But thank you very much for sharing your wisdom and knowledge with us today.
Well, thank you for having me.
Yep.
Dilip, thank you so much for spending the time with us and educating our students and listeners about this issues surrounding financing of hotels, and particularly for the students' careers in real estate. I really appreciate you spending the time with us. Everyone listening, thank you so much for attending the sessions that we have had during the past semester. We had some very, very nice speakers that came, and appreciate you all listening. Also, I want to mention that a series like this is never possible without the help of so many people. And I want to particularly call out a few of them: my colleague and co-host, Professor Leora Lance, Mara Littman for writing all the scripts, Charlie Flomenhoff for doing so many things I don't even know, including the technology, Stephanie Garcia for doing all the marketing, Calvin Juno for working on the videos, and particularly the listeners, everyone who tuned in to listen. Thank you. This was our last one for this semester. However, we are planning a summer conversation series. Please watch out for those details. And in the meanwhile, stay safe, have fun, and I hope that everyone gets to enjoy some leisure time. Thank you.